So hey guys, welcome back. Welcome back to another episode of Accelerated Real Estate Investor. Today I have my good friend Daren Blomquist on the show. Daren is the Executive Vice President of Market Economics at Auction.com. Many of you know Auction.com, massive platform that auctions and sells properties, but they're also a massive data aggregator. And Daren is essentially their economist. So in this episode, which again, if you hear the audio portion, which is great, try to go find this on YouTube so you can also see the slides, because Daren and I have about 8 to 10 slides that we're going to share. And what we're going to talk about today is primarily the different levers that are being pulled, which is forcing the residential market to continue to be on fire, to continue to grow, to continue to have price appreciation. Some of these levers that you're seeing, okay, right now is number one, interest rates. Interest rates have gone down about 19%, which is making mortgage payments go down, which is making them more affordable, which is resulting in higher prices. Secondly, you're seeing that wage growth is happening, about 4 to 5 to 6% wage growth. So people are making more money even in the middle of the pandemic. So as they make more money, again, they can afford a slightly larger mortgage payment, and in turn, can afford a larger, more expensive home. That's forcing prices up. Number three, the foreclosure moratoriums. So foreclosure moratoriums are still active on all government loans, but you're going to see how Daren evaluates and shows how some of these foreclosure moratoriums literally completely stalled out foreclosures just 1 quarter ago. And you're going to see that foreclosures are starting to happen. They're starting to be processed, but we're still 70% below the pre-pandemic levels. So foreclosures are not happening, which is also forcing prices up. Also, number four, right now there's just 1 million properties across the entire United States that's actually on the market, according to the National Association of Realtors, just 1 million, okay? That is an all-time low. For as long as the National Association of Realtors has been tracking these stats, the 1 million properties that are on the market is the least amount they've ever had in our country's history, as long as the NAR has been tracking these stats. So again, you have all-time low inventory, which is pushing property values up. So there's all this data and more in this latest episode of Accelerated Real Estate Investor with me and Daren Blomquist. You're going to love this episode. Take a listen.
Welcome to the Accelerated Real Estate Investor Podcast with Josh Cantwell. If you're looking to retire early with forever passive income, you're in the right place. This podcast is the go-to destination for real estate investors, both active and passive, and multifamily apartment investors, new, intermediate, and advanced. Now, sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Real Estate Investor Podcast.
So hey guys, welcome back to Accelerated Real Estate Investor. I am excited to have Daren Blomquist back on with me again, VP of Market Economics at Auction.com. And we're going to have an amazing conversation around what's going on with the real estate market, primarily residential market. What's going on with existing sales? What's going on with supply? What's going on with demand? I'm sure you're all asking yourself, why does the market just seem like it keeps going up and up and up, and people are competing for deals, competing for properties? You probably have a lot of the same conversations, same questions. I do too. The guy that I rely on for that data is Daren Blomquist at Auction.com. Daren, thanks so much for joining me yet again on Accelerated Real Estate Investor. How are you?
I'm doing well. Thanks for having me. Always good to be here, Josh.
Yeah, absolutely. So just real quick, if you're hearing this on a podcasting platform, whether it's iTunes or SoundCloud or some other podcasting platform, and you're catching only the audio, make sure that you jump over to YouTube to watch the full video, because Daren does have some amazing slides to share with the data that we're going to discuss. So it might just be a little easier to digest if you're also watching the slides. And so Daren, let's jump in. Let me just have you kind of bump through some of these slides. Let's right away start talking about affordability and existing home sales and these kind of things. I guess before we even jump into those slides, Daren, high level, what's going on with the market? What's your thoughts?
Yeah, I think the market is just, as you alluded to a second ago, is just outperforming everybody's expectations, and including mine for sure. The thought of a recession and a pandemic, the initial thought is that's going to hurt demand in the market, but it absolutely has not. And, a lot of that is due to the stimulus brought in from different government sources, including lower interest rates, which the Fed has impact on. And then, of course, the stimulus bills passed by Congress. And so that's brought in demand, and that coupled with the fact that we were already going into this in a very low inventory environment has lit the housing market on fire. And hopefully it's a fire that will stay under control. But right. I think that's the concern is, are we adding too much fuel to a fire that's already strong?
Already burned.
Because you have these underlying demographics that were already in favor of the housing market in terms of, millions of millennials who were hitting home ownership age coming into the pandemic. And then you had builders who had been very conservative in the wake of the last recession in building. And so you had strengthening demand, lower supply, and then you throw on some gasoline on the fire in the form of even lower interest rates and stimulus checks. And that has created what we're seeing here. And it's a raging fire. Hopefully it's not a dumpster fire, but right now it's good for most people, I think.
Got it. Fantastic. So let's talk about this issue of low inventory. So let's kind of go from high level to more of in the dirt. Tell us a little bit about what's happening with inventory and home affordability. Obviously, as prices go up, or affordability gets very difficult. So what is the data telling you around those topics?
Yes, just looking at the NAR data, which we have on the slide here for those who are listening and can't see, but the inventory was already before the pandemic going down. We were seeing back in January 2020, February 2020, year-over-year declines of 10 to 11% in the available inventory of homes for sale. So that was already going down, but now that's accelerated. And we're now down to, in February, a 30% year-over-year decline in the number of homes available for sale compared to a year ago. And we're down to 1 million homes listed for sale on the market, which is a record low for the entire scope of the time that NAR has been tracking this, which goes back decades, I believe. And then the days to sell is 20 days to sell on average, which is also record low. And then that 30% drop in inventory is a record high in that 30% drop. And so all these record numbers leading to supporting the fact that there's just what your listeners know on the ground to be true probably is that there's just not a lot of inventory available to buy. And that is certainly sparking concerns about affordability because that's pushing up home prices.
Yeah. There's all this talk around affordability and how do you continue to make home prices affordable for the average American. It is difficult because even if you're a builder looking to build affordable homes, now the price of lumber is up 3 or 4 times, right? What it used to be. And how do you build affordable homes for people when there's so much cash in the system that it seems like everybody can afford a home? And interest rates are also still hovering at all-time lows. So people's mortgage payments are low, and it creates a substantial challenge, I guess, for both policymakers and for banks and for community leaders to just have homes and things that are affordable. I mean, I can't believe how many homes I've heard that are selling for 25% more even a year ago than what they thought they would get. It's just in houses that have 30, 40, 50 showings in the first weekend and 10 offers over asking price. It's just wild. So tell us about the affordability treadmill, kind of comparing people's home price appreciation and their monthly payment. Obviously, the monthly payment, which is what most people bank on in their budget, why is that so important in determining affordability?
Yeah, at the end of the day, home prices going up is one piece of affordability, but really at the end of the day, for someone who's buying a home, most people, at least unless you're paying cash, it's how much is that monthly payment, and what percentage of my income is that? Can I afford that? And interest rates tie into that. And so we've seen home prices accelerate back in May of 2020, right in the aftermath of the pandemic declaration. Home prices were only up 2%. In February of this year of 2021, they were up 16%. I mean, which is just crazy and I think most people would agree that's unsustainable. But because interest rates at the same time are down, mortgage rates are down 19%. Your monthly payment on a mortgage is only up 6%. So affordability isn't as bad as you might initially think when you see that 16% rise in home prices, but it is, the stimulus in the form of lower mortgage rates is designed to stimulate demand, which it certainly did. And I call this a treadmill is because it's kind of like you have those two levers on the treadmill, or two things that you can control, which is the incline and the speed of the treadmill. And the thing is, if you consider, if you consider mortgage rates the incline and home prices the speed, is what we've seen with mortgage rates going down is we've lowered the incline. Oh, so we can run faster, but then the faster you run, the faster the pace of the treadmill speeds up. And so it's hard to really catch up with affordability. And what's happening is those monthly payments are starting to go up, even though interest rates are down. And so they're up 6%. And if we look, the next slide shows then that 6% rise in your monthly payment on a medium priced home, it's up 6% year over year. Wages are only up 5% year over year. Now, before February, wage growth was actually outpacing that growth in the monthly payment.
Right.
And so that was spurring this rise in home prices because people were, of course, this is very generally speaking, broad brush, but on average across the country, people were earning more. Their earnings were going up faster than a monthly payment on a medium priced home. And so, hey, we can afford to buy a home, and it's more affordable than it was a year ago. Mm-hmm. But that did change in February, where that 6% rise in the monthly payment has outpaced the average hourly earnings, which is at 5%. So I think if we see that, that's an important milestone. And if we see that continue, it's an early indicator that we will finally see a slowdown in home price appreciation in the coming months.
Yeah. Well, I guess a common man's interpretation of this, the way I'm reading this, Daren, is home prices are up, but again, the price is what you paid for the home. Let's say it was $400,000 and now it's $450,000, or it's $800,000 now it's $900,000. That's the price of the home, but it's all relative to how much can we afford. And if our hourly earnings are going up, and then our payment is going down, or the payment is staying about the same because interest rates are down, and the kind of hit to the actual wallet every month is about the same, or even going up a little bit, that is allowing home prices to continue to rise, because the monthly payment, which is what most people budget off of, the reduction in interest rates has worked in their favor, and their hourly earnings has worked in their favor, allowing them to pay more.
Exactly.
And that's why prices are going up. And then you sprinkle more, more of that, dust that just keeps the fire burning, whatever they call that stuff. The fact that there's no inventory, so people feel like they have to almost, like in a chaotic way, outbid a neighbor, a friend for the home. because there's no supply to work off of. You've got three factors really: supply, income growth, and interest rate decline, which to me seem like those three factors all work in the favor of pushing prices up. To me, again, people are like, well, do you think this is going to continue? I said, well, the data's the data. Numbers don't lie. And to me, that all makes absolute perfect sense on why prices would continue to go up. Mm-hmm. And if these things continue, then prices will continue to go up, right? And I think what will happen, and I told my wife this just yesterday, Daren, I said, look, I don't think there's going to be this, all of a sudden when these eviction and foreclosure moratoriums are over, I don't think there's going to be a massive amount of foreclosures. I think it's going to go up, but I don't think there's going to be this 2008, 9, 10 situation because people are being bailed out by increasing home prices, right? So even if they're going into foreclosure default, it's not like 2008 when there was tons of foreclosures defaults and prices were coming down. This time there's very few foreclosures relative. I know we're going to talk about here in the next couple of slides, but people are being bailed out because their home prices are going up. So they can refinance, they can sell, they can work out a loan modification. There might just not going to be this crazy amount of foreclosures hitting the auction steps and short sales like there was in 2009. I just don't see it. Maybe the data will tell us otherwise, but I just don't see it right now.
No, absolutely. I mean, there is most definitely a backlog of foreclosures that actually is contributing to this market craziness that we're seeing, because that inventory has not hit the market, and we do believe it will eventually hit the market, but it won't be the huge wave that we saw back in 2008, to your point. And you don't have that huge wave hitting on top of already bloated inventory. Back in 2008, the builders had overbuilt. So even if there is a somewhat sizable wave of foreclosure inventory, it's almost like the market will eat that up, for breakfast. So
yeah, like a breakfast burrito.
And it won't. It's hard to envision that having at least nationwide, having a huge impact on home price. Having a hit on home prices with the size of inventory that we're talking about there. And we'll talk about that in a second more. But
yeah. Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast. What's happening with home price appreciation relative to REO auction sales? It's the right side of your screen there. It looks like REO auction sales are even going up even faster.
Yep. Investors are very bullish, at least using our platform, very bullish about the market. And I think they should be. I mean, I think there's data to support that. And one of the points I wanted to make with all this is, for real estate investors, this is great news for selling their properties. Like you alluded to a minute ago, I've talked to many investors using our platform who said, they bought a property maybe right before the pandemic or in the pandemic, and they thought they were going to lose money on it. And then they flipped it and they've made more money than they even expected because of these market dynamics that we're seeing. And so this is all pretty good news, especially on the exit side, the disposition side for investors. But on the acquisition side, it is tough because we're seeing a lot more competition for less inventory on our platform.
Right.
And that's resulting in February. Now, these are smaller numbers than the NAR numbers, of course, on our platform, but we saw a 31% increase in the average sales price for an REO property that sold on our platform in February compared to a year ago. And that's almost twice what the 16% increase in home prices across the board. And one thing to point out there, though, is it's still the average price of an REO on our platform is still it's actually crazy to say this, but it's still much more affordable. It's still a discount in a way. It's under $200,000. But it's crazy that that's a discount, a discounted price at this point. So there, investors are flocking to that because they can find these distressed properties that they can add value to, but it's pushing the prices up even on those distressed properties.
Yeah. Wow. Great information. So what's next? Let's talk. You said 200,000 a second ago. This slide tells us the average retail price of a flipped property is close to 250. So yeah, buying it for under 200 is a deal. But the average market sale price in 2020, that's across all homes. Is that right? It's 364.
Yeah, that's average. I think a lot of times people may see the median price coming out from the NAR. We looked at the average price here, which is higher. It skews higher just because your averages are affected by the higher priced homes. But we did that to compare to our platform where we have the average sales price. And that 249, so that's not the acquisition price of the foreclosure, it's the flipped price. So after you've renovated and flipped that property. And the 200,000 I referenced a minute ago are properties that are bank-owned properties. Those actually tend to be higher priced. We also sell foreclosure properties at the foreclosure auction. The average price on those is running closer to 100,000 to 150,000 on those. So anyway, people are buying those, let's say 150,000, they're turning around within 6 months to a year and selling them for 250,000. So you're making this nice profit most of the time. Of course, that doesn't include expenses, but the point I'm trying to make here is even those properties being flipped by investors are affordable inventory for the housing market at 250,000 versus the 365,000 average price according to the National Association of Realtors in 2020.
Wow. I don't know why, but I remember like 10 years ago, the average price of a house was like 160, 180. Yeah, now it's crazy. 360. Wow. Yeah. I've been around too long. Daren.
The NARs, we're getting old. I remember when you could buy for a nickel.
Oh, that's crazy. Tell us about rental properties and rental incomes and rental payments.
Yeah, just the same with those, especially considering the eviction moratoriums.
Yeah, so the crazy thing is we see demand we sell occupied bank-owned properties on our platform, which we would think that the demand for those would plummet given the eviction moratorium. But the demand for those has strengthened in the pandemic and in the midst of a eviction moratorium. So there's still plenty of investors lining up to buy those occupied REO properties, which means, you take on an occupant who you may have trouble getting out of the house because of the eviction moratorium. Or actually, a lot of our investors are very creative and will rent back to the current occupant or even do a buyback arrangement with the current occupant. But the point here with the slide is that when we see the average rents of the properties purchased on our platform that are not flipped, but instead held as rentals, we're seeing those are running 20% below the fair market rents in the counties where those are located. So again, we're trying to make the point to policymakers and others and banks that the market needs inventory right now, and especially affordable inventory, and investors, by buying foreclosures and either flipping them or fixing them up and renting them out, are providing that affordable inventory at anywhere between 20 and 32% below the average market prices or rents.
Wow.
So the average rent is about $1,200 for a 3-bedroom home for properties that have sold on our platform and then held as rentals. Whereas in the same markets where those properties are located, the average rents on a 3-bedroom home is $1,500.
Wow. So investors are looking for, again, I think it's affordability and inventory. They're looking for affordable homes. They're looking for inventory. And maybe investors are stretching, buying properties that they might not consider in the past, because in the past, I would almost never buy a property that was occupied because for fear that that tenant would cause a problem. But when there's no inventory, you kind of will buy whatever's kind of out there, the best of the worst, I guess you could say, when there's no inventory. And if that's something you've got to kind of reach for or stretch for, because that's your business of investing in real estate, you make that reach if you have to and hold on, because again, we know that inventory is so low. I think we have a reasonable expectation that properties will continue to appreciate. So even if it gives us trouble in the short term, probably going to be a pretty significant and positive investment in the long term.
Yeah, that's a great way of saying it.
Yeah, you bet. So I know it seems like on this next slide we talked about before we started recording that foreclosures are still way down pre-pandemic levels, but there's more activity starting to happen. So tell us what's going on with the foreclosure auction trends.
Yeah, just high level, the green here means foreclosure volume is starting to return more quickly. But even in the green, in most of those states, we're still below pre-pandemic levels. So if you look at Indiana, for instance, now that's actually one of the states that's come back the strongest. The 87% there means that in the first quarter of 2021, we saw 87% of the foreclosure volume on our platform that we saw a year ago in the first quarter of 2020. Or another way of saying that is we're 13% below year ago levels. So we're below, nationwide, we're 70% below year ago levels. But the green is generally where we're starting to see that volume come back. And I think it may surprise people, there's a foreclosure moratorium, there's no foreclosures available. Where are all these properties coming from? And the answer is that the foreclosure moratorium applies to only government-backed loans, which is 70% of the market. But there's still 30% of the market that's not government-backed loans. And then additionally, the vacant or abandoned properties are exempt from the moratorium, even for government-backed loans. So you have the vacant or abandoned properties that are still going to foreclosure. And unlike when I was talking about the occupied bank-owned properties, almost all of these properties that are going to foreclosure auction are vacant or abandoned, which typically an investor would prefer.
Oh yeah.
We're seeing some of the things that stand out to me here are that when we looked at this in the fourth quarter of 2020, we were 80% below year ago levels. Now we're 70%. So we're gradually coming back. And states like Florida stands out because I believe in the fourth quarter, it was more like under 20%, or it's 34% of year ago levels. Now it was under 20% back in the fourth quarter. So we're coming back in a high volume state like Florida that has a lot of inventory. Even California, which is notoriously, very consumer protective. We see 25% of year ago inventory. And New York is still at 5%. So we're 95% below year ago levels, but in the fourth quarter was at 0%.
Yeah.
So some of these states, even the states that tend to be more, protective of consumers and wanting to make sure absolutely nobody is foreclosed on improperly. And also with New York, you have the court system that handles the foreclosures. So that's another layer. Anyway, we're starting to see some movement even in a state like New York.
Yeah, it's wild. Everything is still way below pre-pandemic levels, 70% down. So when you look at the slide, when you see the positives and, think like, oh, they're up from the fourth quarter for sure, but still way below, again, 70% below pre-pandemic levels. So, and Daren and I were talking earlier about how we feel like, 6 months from now, a year from now, when the foreclosure moratorium is lifted and they can process these foreclosures, because the inventory is still so low across the board, a lot of people are going to be rescued by the fact that their home prices have gone up. They can refinance, they can do a loan modification. The banks are just not going to be, I think, overly aggressive like they were in 2008, 9, 10, because banks know prices are going to go up. So banks are not going to be as willing to do short sale on a property with rising prices. And also, I think the banks have gotten smart to know that they can be a little more strategic when they allow properties to hit the market. We all know that banks kept so much inventory off the market back in 8, 9, 10, but there was so much inventory to process, they had to let some of that inventory hit the market. Now they have this working in their favor where if they do process a foreclosure after it's lifted, the moratorium's lifted, they do process a foreclosure and put it on the auction.com platform or put it on another platform, share of sale platform. There's so little inventory, the bank knows that they're going to sell it for a really good price and probably recoup most, if not all, of their investment in the loan. So there's just not going to be, economic Armageddon. Again, I think this is just another way of looking at the data and, coming to a theory that says there's just not going to be economic Armageddon. Real estate's not going to be the cause of the recession. It's actually going to help the country through the recession, which is what it appears like it's doing now. Fantastic stuff, Daren. It's great. Anything else on this slide before we move on?
No, I think that covers it there.
What types? I think this next slide is the types of foreclosures that are happening. So tell us what's going on with,
Yes.
the Fannie Freddie stuff and then the private stuff, and where are foreclosures being processed, and what loan types are the most out of the pie, out of the pool.
Yeah. So this is kind of the same view as the last slide, but instead of geographic, it's by loan type. And so, the percentages there are percentage of year ago levels. So if we look at USDA there, it's the highest volume compared to year ago, 37% of year ago levels, compared to nationwide 30%. And so volume but USDA only counts for about 5% of the volume on the auction.com platform. I think a key one here is FHA, and that's where we see the biggest weakness in, even leading into the pandemic, in the mortgage market. Those were the riskiest loans in the business during this housing boom that we've been in, given the low down payments and high DTI, debt to income ratios on those loans. And we are seeing those at 33% of year ago levels. And again, FHA and Fannie and Freddie, USDA, VA, those are all government-backed loans that are subject to the foreclosure moratorium, but we're still seeing foreclosures happening because of that vacant and abandoned property exemption. And FHA accounts for 29% of all of our volume on the platform. Fannie and Freddie is slightly higher. They account for 31% of all volume. And they're at 30% of year ago levels. So not quite as high as FHA. And then I think maybe a little bit of a surprise is the privately owned loans, which are not subject to the foreclosure moratorium. We're actually seeing banks be more conservative with those. And those are only at 28% of year ago levels, even though they could theoretically be foreclosing on all of those because they're not subject to the foreclosure moratorium. Of course, some of them are in forbearance, so that's another factor. But this is the mix. I think the takeaway for me here is that there's not one loan type that is dominating, actually. We do expect FHA is an outsized proportion of the market. If you look at originations, FHA only accounts for less than 20% of loan originations, but they are accounting for 29% of foreclosure volume. So that's one to look at. But other than that, I think the point is we're seeing foreclosure inventory from all types of loans coming back. Again, slowly, but it is coming back.
My newest and most powerful real estate investing book, The Flip System, is now available. And for a limited time, you can grab your free copy at getflipsystem.com/podcast. Using the same proven principles secrets, and investing strategies I'm sharing in this book, I've been able to personally close over 750 highly profitable real estate deals over the last 15 years, make over 400 private lender loans, raise over $30 million of private money, and acquire over 2,000 units of apartments. Get my newest book now for free for a limited time at getflipsystem.com/podcast. That's getflipsystem.com/podcast.
Yeah, interesting. Interesting that the private and non-performing loans, that they're not pushing harder to foreclose, considering prices are going up, but they might just be biding their time, assuming that prices will still keep going up, and they'd rather work it out with the borrower than foreclose. And I know, like, we have a foreclosure that's going on in Washington, and I saw your slide back a couple slides ago that was only about 11% of pre-pandemic levels. And it's driving me bananas because it's a private loan that we made on an abandoned house, and the judge won't process the foreclosure. We already have actually been granted the foreclosure at the foreclosure auction. We bought the property back, and they won't kick the borrower out because the borrower has claimed that they have llamas on the property. They have animals. And we even got an ejectment, meaning that the sheriff is supposed to forcibly move them out, and they will not process the ejectment. So the guys abandoned the house. We've been granted the foreclosure. We've already bought it back. We've already been granted an ejectment, but they will not officially give us title to the house, let us renovate it, let us put it on the market because there's llamas there. So you've seen all kinds of crazy stuff.
I hadn't thought about
Is that in your slides, Daren? Oh, fantastic stuff. So it's crazy, some of the stuff that's going on in the market. Let's talk about population migration. I know this is your next slide. I'm always interested to see where people are moving. What's your interpretation of net in and net out migration? Where are people moving? This, to me, the reason why I ask is it's an indicator of where values could be going up. And if you're thinking about riding the wave of potential growth, okay, where do we want to invest in? Where do we want to buy in? Where property values could go up because migration's moving in. Tell us about some of the areas that are doing well and some of the areas that people are moving out.
Yeah, and this is great data from CoreLogic that CoreLogic did. Zillow also did a recent mover report that's actually not quite as detailed, but shows a similar trend, which is, and we were seeing this before the pandemic, to be honest, but the pandemic has accelerated it, which is movement from the coasts and toward the interior of the country is kind of the big picture. So the red there is out migration, blue is in migration. So people are fleeing the coast, going to the interior. The main driver of that, even before the pandemic, was affordability. And pandemic has accelerated that because you have the affordability factor. It's much more affordable to buy a home in, let's say, one of the red areas there, let's say Tampa or even Lakeland, Florida. Much more affordable to buy there than it is in, and I just realized I reversed. This might be confusing. I reversed the colors. The bottom section should be blue. But anyway, it's much more affordable to buy in Tampa or Lakeland than it is in Los Angeles. And on top of that, if you have a job in Los Angeles, you may now be able to move to Tampa and still work from home.
Right.
And buy a much bigger house. So that's, I think, really the short story of what's happened here with this migration in 2020. And it's pretty clear. You just kind of squint at this map and you see people are fleeing the coast and going inland.
People are going inland. People are going to places that are more affordable, like a lot of those markets in we talked about affordability multiple times today. In Florida, Jacksonville's always been affordable. Lakeland, Tampa, it's not as expensive as Miami. It's not as expensive as Naples, let's say. Obviously, Dallas, San Antonio, those kind of areas. South Carolina, North Carolina, Georgia, a lot of stuff in the Southeast is much more affordable. Also, I'm sure there's, just some taxes. A lot of the bigger cities have more taxes. Chicago, Seattle, New York, LA, taxes are higher, state income tax. Of course, Florida has no state income tax. Does Texas have state income tax? I can't remember.
Texas does not.
Texas does not.
So, yeah,
Florida
that's
does
another
not.
one. And actually, Washington doesn't either, but it's interesting. You look at Washington and Seattle, people are leaving Seattle, but then you do see the in-migration in places like the little blue dot there is right by Idaho is Spokane. So people are moving inland from the high-priced markets, even in a state like that, to the inland markets.
Yeah. So a combination of affordability, taxes, some could be policy. I think it's fair to recognize all of the riots last year, some of the defunding of the police. I think that was unsettling to some people that wanted to move out of large cities and wanted to move inland or move to the suburbs. And then, of course, like the point you made, Daren, where people just don't have to live in a major city in a high-rise condo to do their job because they don't have to live and work in the city anymore. They can live out in the suburbs. They can move out, let's say, from LA to Riverside or from San Jose to Las Vegas and still do their job and live just more in a sprawling suburb than in a downtown high-rise. All of those things are just being exacerbated on top of affordability, which is, I think, probably the number one reason is just I can't afford it anymore. It's just eating up too much of my paycheck to live downtown. So really, really good information. So if you're a real estate investor, look at this slide. And again, what am I thinking? I'm thinking Midwest, Southeast. I'm thinking Texas. Those are happening, but don't give up on areas like the suburbs of LA. People are moving to Riverside. Don't give up on the suburbs of New York, New Jersey, right? There's a lot of migration in those directions. Primarily what you're seeing is people just, leaving major urban areas for all those reasons we mentioned already.
Yeah, I think those are really good points. And I think the good news for investors a little bit is if you compare this map to the volume map, there's where the inventory is coming back, at least somewhat correlates to where people are moving. And so there is some more inventory. If you're looking in the Southeast and Florida, we're starting to see the numbers come back there. By the way, I just want to mention Texas is low, and we expect it to be higher in terms of inventory coming back. The reason for the low inventory there, I think, primarily is because of there was some natural disaster declarations as a result of the cold snap that they got there, which I'm sure Ohioans would have just dealt with.
We would have laughed.
Yeah. But
built for that stuff.
But anyway, that postponed some of the foreclosure activity there as the FEMA came in and did some natural disaster declarations. We would expect that to bounce back as a result of that in the next few months.
Got it.
So, yeah.
Awesome, Daren. I know we just got like 1 or 2 slides left, and I know we're running short on time. I know you've got another obligation as I do. I believe we're on our last slide here, or that might have been it.
Yeah, I have more stuff, but yeah, I think this is the last one we had talked about.
Really focusing on. Daren, I know you guys have an area where we'll make this slide deck available to my members inside of some of our membership sites if you guys want to get access to it. But I know DarenAuction.com has areas where people can log in, they can get an account. Tell us about that. They can enter the newsroom. They can see all this information you guys publish. Not only do you have lots of properties to sell, actual physical inventory to buy. So of course, my subscribers and members should go to auction.com, register, and then look at their inventory to buy. But also this data is regularly available. Daren's on all kinds of different news outlets producing this information that you can get directly from their site. So Daren, where are some places that our audience can go engage with your company and get this information, register for an account, and get the news?
Sure. Yeah. In terms of this kind of research and analysis that I do, it's all under auction.com/in the news. So auction.com/in the news. In terms of finding actual properties to buy, which is probably of the most interest to a lot of your subscribers, is you just go to auction.com and you can start searching right away. It's not a subscription-based service or anything. It's free to use. You do have to if you end up bidding on a property, you have to register to bid, and then if you win the bid, you have to you have to pay for that property. But it's free to go in and search, and we do. A couple things is we have some of this inventory I've been talking about that's starting to come back, and on top of that, we have it ties into something you said earlier. We have banks approaching us who are interested in being more proactive and selling properties in pre-foreclosure. And so these may not even be short sales, but they may be homeowners who can't make their payments, but they even potentially have equity in the homes and they want to sell. And traditionally, they would list those on the market, and they are doing those. They're listing those on the MLS. But the banks are actually coming to us and also posting them on auction.com because they're finding they can sometimes get a better buyer base of investors who are willing to act quickly on these properties. And so that's a new type of inventory you can look for. We call it, we call those pre-foreclosure sales. And so those are even before it goes to foreclosure, where and it may be a short sale or it may be an equity pre-foreclosure sale where the homeowner just needs to sell. That's a new type of opportunity that's available on the site now too.
Fantastic stuff, man. You guys are always innovating, always bringing great information to the entire community. And I appreciate you carving out some time just for my subscribers and for our accelerated investors, Daren. So as always, thanks for joining us. For all my subscribers, make sure you go to auction.com and specifically auction.com in the news to engage with a lot of Daren's material. Something you should be checking out really on a monthly basis. And, we'll have Daren back again very soon, maybe next month, and certainly once a quarter to share this type of information. So Daren, again, just much appreciation, gratitude. I appreciate you carving out time for us on Accelerated Investor.
Absolutely. Always good to be here and hear what you have to say too, Josh.
Wow, that was an amazing interview with Daren Blomquist, the VP of Market Economics from auction.com. Don't forget to check out auction.com/in the news for all of the data that Daren aggregates and compiles. Don't forget to go to auction.com to look for more inventory. If you enjoyed that episode, please give us some feedback. It would mean so much to me. I'd be so grateful if you'd go, leave us a rating, leave us a review, and don't forget to subscribe so you never miss another episode of Accelerated Real Estate Investor. Again, we have Daren back on the show once a quarter, at least once a quarter, because this information is so timely. It's so important. We just love having Daren on the show. All right. Don't forget to reach out to him as well. So again, like, subscribe, rating, review. Never miss another episode of Accelerated Real Estate Investor.
Hey, Josh here, and do you want to win a free Accelerated Investor t-shirt? All you have to do is give Accelerated Investor, our podcast, Accelerated Investor, a rating and a review on iTunes, okay? Do that now. Then send us a screenshot on Facebook or Instagram or Twitter. What we're going to do then is every week we're going to pick our favorite rating and review, and we're going to send that person a free t-shirt and maybe, again, some other cool, fun stuff as well from Accelerated Investors. So, again, don't forget to take a screenshot. Leave a rating, review, take a screenshot, send it to us so we know exactly who you are. And then once a week, every week on the podcast, we will announce a new winner. Don't forget to take a screenshot and send it to us so we know exactly who you are. We'll announce a new winner every week.
You were just listening to the Accelerated Real Estate Investor Podcast with Josh Cantwell. If you enjoyed this episode and learned something new, help us build our community by leaving a review and 5-star rating on our iTunes podcast channel. Also, don't forget to subscribe so you never miss another episode. To see passive investing opportunities, visit freelandventures.com/passive. To start your journey toward the lifestyle you've always dreamed of with multifamily apartments, apply for one-on-one coaching with Josh at joshcantwellcoaching.com.